Joining us now to look ahead to next week's action is Lori Calvasina of RBC Capital Markets. Lori, happy Friday. So you think the market action hasn't fully reflected a ho-hum earnings season and a stretched consumer. So what does that mean for entry points here?
So, look, thanks for having me, by the way. I think we've just had a problem in terms of positioning and valuation coming into today. And I know there's a lot of uncertainty swirling, but I do think the market was largely looking through a lackluster earnings season. I think the consumer's woes have been well known for quite some time. But there was just sort of a chill that came through in company commentary on the overall macro backdrop that was a little bit worse than what we'd been seeing coming in. And somehow the market just ignored that, focused on the election. And it feels like that kind of dour commentary is finally coming back home to roost in here.
So the biggest tech companies were a big part of what brought the major averages to where we are today. Two big things in tech next week. We've got Microsoft Ignite developer type conference and NVIDIA earnings. That's AI demand and supply. How important is it to watch how the market reacts or doesn't to those things?
Well, I think it's always important just in terms of the heavy market cap representation. And even if those stocks underperform a little bit, we still need them to behave in general. And I think that we've just continued to see skittish investor expectations as earnings growth expectations are decelerating. And frankly, a lot of the commentary we've been reading about AI, not in terms of these companies, but in terms of their end users, has really been kind of ho-hum or small potatoes in terms of the, kind of outputs that people are getting from AI technologies so far. So I think there's a lot of skittishness in here. But again, you're sitting at sort of crowded levels. You're sitting at crowded or extremely expensive valuations in these stocks. And there's just not a lot of room for error in here.
So given the fact that we have seen the market taking a little bit of a breather here, Lori, if that continues, do you buy on the dips?
So I think we have generally been wanting to buy on dips, and most of the pullbacks that we've seen in recent years, and really all of them, frankly, since the late 2022 period, have been in that 5 to 10% drawdown. That is within the normal range of a typical correction. Anything beyond that tends to be associated with a growth scare. I don't have a growth scare, sort of a recession near miss on my horizon right now. So we may need to see the market pull back just a little bit more before we get into that kind of 5 to 10% range where you can really pull some froth out. But generally, we do think the economic backdrop is still very, very strong right now.
So what does that mean for Russell 2000 and for small caps, which finished down 4% on the week now?
Look, I think small caps have needed economic tailwinds to come back. I think we sort of put what we were going to put into that market in terms of the Fed. You haven't had sort of peak-like valuations in that space, but you have had peak-like positioning all the way back to the 2016 highs, basically right back where we were the last time Trump got elected. The problem is that I think a lot of the Trump move was pre-traded, and so we're sitting here and now we're dialing down Fed expectations again. So, I think the setup for small caps, as long as we're getting more skittish on the Fed, that's very, very tricky for this space.